We're going to continue this conversation on the markets. Right now, we are joined by Ares Management co-founder and CEO Michael Arougheti. He oversees $149 billion in assets under management. And Michael, thank you for joining us. You spent a lot of time in the credit markets. Tell us how you see it from your seat.
Well, I'm not actually seeing it from a seat where I can see the real economy, because obviously I'm home, but I can give you a view of what's going on in the market. As you said, we're in the credit markets daily, both liquid and private. We have investments in about 1,700 middle market companies. And I'll tell you, across the board, it is tough out there. I mean, thankfully, we saw a little bit of a relief rally at the end of last week in the sub-investment grade and high-grade markets. We saw some pretty significant turmoil in the mortgage markets throughout the course of the last 2 weeks. Thankfully, the Fed stimulus has helped those markets to heal, at least for the time being. I think the challenge that we're having across the board is it's very difficult to price risk at a time when you have a demand shock that's of an uncertain duration. There's just a lot of small, medium-sized companies that went into this crisis period well capitalized, well positioned, and really just were not set up for this kind of a shock. So in the lending markets, private lending markets particularly, whether you're talking about real estate or corporate, there's just a lot of hand-to-hand combat right now. Banks and non-banks really working with borrowers and asset owners to provide liquidity to get through this demand shock and get to the other side when we turn the economy back on.
To the extent that you follow the equity markets and see that it appears that we're having, I don't want to say stability, but some semblance of stability, people are talking about whether a bottom is in relative to what you're seeing in the credit markets. Does it make sense that a bottom is in? Does that sound right to you when you look at the fundamentals of what the world may look like in 6 to 12 months from now?
Yeah, I think we have to be careful not to confuse the equity market with the real economy. Obviously, we saw such a severe move to the downside that we've had a little bit of recoupment, and that feels better. You do have to appreciate we're still on the front end of this. We haven't seen the unemployment numbers really roll through. We haven't seen the stimulus get into the hands of the consumer and the small business. So I think, at least from my perspective, we still got a little bit of ways to go to get the fundamentals to the bottom, and not quite sure that the market is fully factoring that in.
So it sounds like you're more pessimistic than optimistic, at least as of now.
Yeah, I think I would say I'm more short-term pessimistic, but long-term optimistic that we're going to get to the other side of this, given the coordinated effort on Fed monetary policy and fiscal policy. But when you think about what's going on in the world, we went into this early days of the crisis thinking that there were a handful of industries that would be affected by the health crisis: travel, leisure, hospitality, et cetera. And I think now, looking across the markets, it's actually quite hard to come up with an industry that hasn't been affected, whether it's the consumer behavior, inability to support the revenue shocks, supply chain disruption, et cetera, et cetera. So the challenges out there are pretty broad and they're pretty pervasive.
The steps that the government has taken in terms of the small business loans, the liquidity that's trying to be pumped into the system, do you think it's enough? We talked in the 6 o'clock hour with Eamon Javers in Washington about whether a second stimulus bill may be in the offing ultimately.
Yeah, I think we're going to need to do more, both in terms of size and scope. I think we should all applaud the work that's already been done, both in terms of the size of the stimulus and the speed with which it was implemented. And I commend everybody for the bipartisan work in getting that done. I think one of the challenges is we are using the 2008-2009 playbook in a very different type of a crisis. If you think about what we were trying to deal with the last go-around, it was really a bank liquidity-led issue on the heels of a mortgage crisis. This is projecting much more like a natural disaster. This is a Main Street problem, not a Wall Street problem. And a lot of the stimulus that's already found its way into the system is really geared at the securities markets and fixing the plumbing, if you will. I think some of the work that's been done around the Exchange Stabilization Fund and the SBA lending program to get capital directly into the hands of small businesses is a great start, but I think we're going to need to do more to get dollars flowing in the real economy.
What are you hearing from the companies that you're invested in terms of whether some of them are going to take the loans? And the reason I ask about that is I keep hearing from business leaders who are saying, look, I actually don't know if I actually want to take the loan, given that it requires me, if I want it to ultimately be forgiven, to keep 90% of my employees on board. I always thought that was a great idea, except a lot of people are saying, I don't know what the world is going to look like 4 months from now. And I don't know if I want to be able to keep 90% of my employees on board, because it may take 6 months, 8 months, a year longer to actually get back to where I need to be to keep all those employees.
I think it's a great point. We're in the phase now where everybody's digesting the proposed stimulus and frankly, figuring out exactly how to access, as much as they're figuring out whether or not they want to access. But I think your point is a good one. If you just take the small business lending facility as an example, you're really talking about a loan to a small business at 2.5 times monthly payroll. If you have a view that your business has been materially changed, even coming out of that loan either A, may not be enough, or it may come with too much constraint and you may not take it. I think that's a TBD, and it's going to be very company specific.
Final question. Is there any money that you are putting to work, and if so, where?
Yeah, I think the good news, we've been active. Of our $150 billion of assets, about $35 billion of it is uninvested, largely focused in the private equity, credit, and real estate markets. As you can appreciate, the new deal environment is pretty slow. So most of what we've been doing now is in the liquid secondary markets, CMBS, RMBS, high yield, leverage loans, and there were some great values to be had over the last 3 or 4 weeks. And then on the private side, just given what we're able to do on the rescue capital and distress side, we've been pretty active trying to provide liquidity solutions to private companies as well.
And just what's the energy patch look like? Because I know you have money there and also in the real estate space.
I can't use expletives on TV, so I'll just say that the energy patch is pretty tough right now. Thankfully at Ares, it represents only about 2% of what we do, meaning E&P. But challenge in energy right now, we've never seen a simultaneous supply shock and demand shock at the same time, and it's just unprecedented. We're talking about demand contraction right now, about 10 to 20 million barrels over the next 30 to 60 days. Supply in the next 30 days will likely surpass supply that we saw over the 2-year period in 2014, 2016. That is just devastating across the energy sector, not just for high-grade companies, but for obviously sub-investment grade companies as well. Not surprisingly, you're seeing that play through in the energy markets and the securities markets. High-grade energy bonds gapped out, yielding now probably 6% versus 3% going into this. Energy stocks, as you guys know, down 40 to 50%. Very, very tough. And I think this will persist when you think about where Saudis and Russia are from a projected supply standpoint. This is probably going to go on at least through 2020, if not into 2021.